Hi, Jacob Field here from Ripehouse Advisory. Today I've got a very special guest and we're here to talk all things Budget 2022. So thanks for joining us, Scott. Scott from partner at Scanlon Richardson, an accountant who I've known very well over the years, a lot of respect for the work that he does and always looking after our clients above and beyond. So it's an absolute pleasure to have Scott here today to take us through these major changes to the 2022 budget as announced by Liberal a couple of weeks ago. So Scott, maybe if you could give us a little bit of background about what you've done professionally up until this point, it would be great for some context.
Okay, the entire career. Based out of Devonport originally, so I've been working in accounting since 2005. Joined with Scanlon Richardson 5.5 years ago now.
Okay.
Became partner coming up on 3 years ago.
Beautiful.
Scanlon Richardson, deal with a broad base of clients across business and individuals, investors, etc.
Yes.
Tasmania and around Australia as well. Pretty standard service model within the accounting firm, but we really try and put a focus on sort of looking after our clients and not just dealing with that compliance-based stuff. Yeah.
Okay, and from our perspective, we've pointed a lot of investors your way, I guess, over the years who are looking at setting up trusts or any advanced structures around their property investing. And I've always found the advice, you're not giving advice or creating structures just for the sake of it. I think the advice is very neutral, and I guess the best interests of the client I've seen are protected longer term. So it's a credit to you, and
Thank you.
I'm very comfortable in what you do. And I couldn't think of anybody that would understand these changes probably more accurately than yourself. So
Cool.
It's good to have you on and pick your brain because you actually mentioned it over a football game.
Yep.
Our children play football together down here in Hobart, and they are quite major changes that are proposed by Liberal in this budget for property investors. It's actually a game changer, so it's going to be good to unpack that now. So maybe at a high level, Scott, what would be the areas that are impacting property investors directly? We're not talking about the periphery, but this is for property investors only. What would be the key areas in this budget that would impact them?
In the budget itself, there isn't a huge amount. It's more around some other stuff that's happened almost contemporaneously with the budget. So at the same time, the budget itself was, we would say, fairly bland. From a tax point of view, coming into election, that was probably expected, I think. No one's going to take massive risks from that point of view.
Yes.
There are a few things like the extension of the low and middle income tax offset. So most taxpayers will get a nice little $420 kicker on their tax refund that they wouldn't have otherwise got, but I think we expected that was going to get extended. Okay. Anyway,
a nice little election sweetener. For
yeah,
Liberals.
It's always a little one just to throw out. It's a good one for them too because they don't have to say like they're changing tax rates, and they can make that decision right at the end of the year, and it doesn't affect withholding. So it's an easy one for them to throw out there.
Okay.
Most of the other things that were changed were generally in the tax sphere around business clients. So things like some investment allowances for digitising your business. Some things around, again, apprentice support and stuff like that. So for investors, it wasn't a massive budget. Looking forward, though, and some people might have seen some commentary, they have kept within that budget what's called the Stage 3 tax cuts, which were announced quite a while ago.
Okay.
They're coming in 2025.
Right.
And they will see basically a flattened 30% tax rate plus Medicare levy from $45,000 right through to $200,000.
Wow.
Where at the moment we've got people on $45,000, up to that point they're only paying 20 cents in the dollar. People on $200,000 are paying 47 cents in the dollar. So the upshot of that is an individual on $200,000 a year as an employee will have $9,075 more in their pocket every year.
So you mentioned that was a forward change. So
That's a forward
they've
change.
reiterated future change.
Yes.
Or proposed future change. When was that future change earmarked for?
The 2025 year. So starting 1st of July 2024 is the first year that change will come in. And with an election coming up, obviously there's a little bit of uncertainty, but as last time I checked, Labor had stated they would continue to support those changes as well. So we're fairly confident as we can be, that they will become the actual fact in that time frame.
And what sort of tax savings would this be for, say, someone on $200,000?
Yeah, so it's literally nearly like $9,075. It's nearly $10,000 per person as well.
Gee whiz.
Yeah, so if you're a high wealth individual, it's a lot of cash flow that's going to be coming your way at that time.
In 2025. So that's now been doubled down or reiterated in this budget. They have confirmed that this is still going ahead and they are still committed to it.
Yep.
And then we've also had some, I guess, efficiency changes or updates for businesses. So, I guess streamlining things there for a digital transition.
Yep.
And then we've also had a nice little sweetener there for individuals. $420, I think you mentioned.
Yep.
Anything else from particularly for property investors that you can think of
in respect
from
of
the budget?
In respect of the budget, no, nothing really that stands out massively. We've just probably seen, if you want to go into it now, just a little bit of maybe some mindset changes, perhaps.
Okay.
Maybe from the ATO.
Right.
Whether or not that's been directed by the government, I don't think so. They have been very, very friendly throughout COVID. They've been everyone's best friend and happily holding hands. But we've seen almost a sheer drop-off in terms of their attitude and a 180 reversal on a lot of things.
Okay.
For example, around debt collection.
Yes.
We're now seeing just almost exclusively, if a client has an overdue tax return, immediately a $1,000 penalty applied to their account.
Wow.
Upon lodgement of that return, which is just, and they're all getting remitted.
Yes.
Once we ask for them, but it's a really hassle, and there's just a turnaround there. And we've seen some significant debt collection action and some letters going out around company business clients who owe a lot of money. We haven't seen a lot of those ourselves, thank God, but the ATO, I think, have sent, it was 50,000 letters out to clients who they think might be in difficulty. And one of the leading liquidators, again, I can't recall who it was, stated that they thought there would be a huge amount of company liquidations coming up because prompted by those letters, basically.
Wow. Yeah, right.
More likely to hit the mainland, I would have thought, but yeah.
So when you say a change of mindset, obviously the ATO are now focused on collection.
Yeah.
They're focused on tightening the purse strings, I guess, from their, if the ATO are considered a business, I guess they are.
They are.
So they're changing. Obviously, they might have eased the reins off there through COVID. They might have given people a little bit of slack, and you see that those reins now being tied in.
Absolutely. Interest is being charged on accounts now, again, automatically. They've been talking a bit about fringe benefits tax. They've identified that they think there is something like a $1 billion revenue hole in fringe benefits tax through people not properly reporting that.
Wow.
So again, we're talking to our clients right now about that we don't think you've necessarily got any risk factors with fringe benefits tax, but certain things might cause them to look at you, and once they start looking at you, they might start looking at other stuff, and you just don't want that hassle there. So it's a lot of jawboning and talk about these things, and they clearly have definitely changed their mindset in respect of some things there.
Okay, so fringe benefits tax also might be under the microscope.
Yep.
Any other areas that you might be able to that are seeing this change of mindset being applied to? Do you think?
Yeah. So they're probably the two minor ones, because it really has to this stage just been talk and maybe some letters going out and stuff like that. But the big one that's occurred more recently is around trusts, especially discretionary or family trusts. And this is the one that probably will most affect your property investors and high wealth individuals who are looking to invest in property, whether they've got a trust now or whether they would be looking to set one up in the future.
So I might sort of stop you there if that's all right, Scott. So before we dive into these impacts or changes around or proposed changes around trusts, and it is proposed at this point, it hasn't been enacted yet.
It is a draft opinion at this stage of the current legislation.
Right.
Yes.
So it's in the pipeline, and they don't usually sort of go back once
we've
settled down this path.
Anecdotally, we've been told they have no intention of really changing their position on this at this stage.
So it's probably most likely going to happen.
Yep.
Okay. Trusts traditionally for a property investor have given three main benefits, and I might allow you to sort of take a deeper dive here, Scott, but high level, we've got estate planning benefits, we've got asset protection benefits, and we've got tax minimisation benefits. I guess for investors, it also gives a structure that they can purchase property investments in to get those three benefits, and it may then, avoid differences in land tax across states. There might be other individual or subjective benefits to individual investors. It's been quite heavily employed. Trusts have been quite heavily employed by property investors. I'm not talking every investor out there, but probably 1 in 20 properties, 1 in 10 investment properties would be purchased in a trust structure.
Yeah, that's and certainly when we start talking about commercial or high wealth properties, especially, we really look at I would say probably more than half.
Yes.
Around that. Yeah.
Okay, so it's not everybody, but it's a decent chunk of property investors in Australia do employ these more advanced strategies for property ownership. That's a little bit of background. A trust structure, how much would they cost usually to set up for a property and potentially administer?
Yeah, so our general fee is somewhere around about a trust with a company acting as a trustee, which is the safer of all those options, somewhere around about 2,200 plus GST. That includes all the costs and all the ASIC fees wound in and stuff.
Yes.
Certain states also have some stamp duty attached to that, and that really varies by state by state. Tasmania, we have no duty. New South Wales is $500, so that can vary quite heavily.
Right.
I also then tend to suggest to clients that the ongoing maintenance of a trust will be about $1,000 to $1,200 more than it would be if you just own that property individually. Because if you buy a property individually, the cost of getting your individual tax return will also go up a bit.
Yep.
So I tend to suggest that the trust will be around about $1,000 to $1,200 a year.
Each year,
additional in terms of managing the compliance and stuff like that.
So that's the cost. And I'm just sort of setting the scene here, guys. This is the old trust structure, or the old benefits, I guess. $1,200 a year, a bit over $2,000 to set it up. Sometimes maybe closer to $2,500, if not a little bit more in New South Wales. That's the setup and ongoing administration. But the benefits, once again, tax minimisation, asset protection and estate planning. Can you maybe give a high-level helicopter view of the previous benefits there for investors for trust structures?
Yeah, so the previous benefits for the two that you mentioned there that still exist and haven't changed are around estate planning.
Okay.
So things like being able to hand property and those sorts of things down intergenerationally between families, etc., or hand management of those things down much more easily.
I might stop you there. So let's just break that down. So we've got a property that's owned by a trust. That is the corporate entity that owns the property.
The property, yes.
You don't own it personally.
Yep.
And then you may be a beneficiary of that trust.
Yeah, most of the deeds that we have, the trust deeds, which is the rules and the laws of the trust, will generally be a very open-ended document, which will generally say that we might have some specified beneficiaries when we set it up, which is usually maybe mum and dad, something along those lines.
Okay.
But then the deed will extend that to be anyone basically in your family group or anyone else that you choose.
Sure.
Now, from a tax point of view, at some point we might need to do a family trust election, which would restrict that back into just the family group and entities that you control.
Okay.
But yeah, it's generally a pretty open-ended group of people who can benefit from a trust. Yeah.
So if you own the property directly and you wanted to pass it down to the kids, this doesn't need to be on the deathbed. This could be, at any point.
Yep.
You would have to sell it to them.
Yep.
And they would have to pay stamp duties.
Stamp duty and CGT as well.
CGT on any profits from the property or changes in value. That is a significant, potentially a significant amount of money.
It is.
Right? Yep. When it's owned by a trust, it's a literal process of changing the beneficiary.
Changing the trustee, more to the point.
Changing
so
the trustee.
The trustee is the entity or person who runs the trust. Again, especially if we've got a company acting as trustee, it can be as simple as changing the shareholders of that company and changing the directors, and all of a sudden we've got a transfer of management.
Okay, so you're not getting CGT, you're not getting stamp duties that are payable, etc. It's not a transaction, it's the ownership structure is changing, the property is not transacting.
It's simply just change of management more than anything else,
Okay, so that's the benefit, and that could be substantial.
Yep.
But then we've also got the ongoing administration of a trust, so that could probably be, needs to be weighted. If over 50 years we're having to pay $1,200 a year,
adds up.
That does add up.
Yep.
Traditionally there have been other benefits which we can talk to in the moment, but that does need to be weighed if that is the sole benefit. So asset protection, how would that sort of sit with a traditional with trust, and is that impacted by these changes?
Again, no, that's not impacted by these changes at all. So, and that's a bit of a two-way street. So asset protection is either protecting the assets of the trust from maybe personal liabilities that you might have, or vice versa, protecting you personally and your assets from risk of what's happening within the trust.
Okay.
And it really depends on everyone's individual circumstances. We might have an individual who perhaps is a director of a construction company, for example. It's a very, very high risk thing to do. You've got all sorts of things you can get stung for there.
Yep.
A trust may be able to provide you with some protection around the investments that you hold in the trust. It's never perfect, but you're almost certainly never going to be in a worse position by having those assets maybe in a trust and not exposed to your personal liability.
So maybe just to elaborate on that, you own, or there's a property investment, it is owned by your trust, you are the director of a company, you are sued, or there's bankruptcy proceedings, etc. There is the potential that property can be insulated or hived off from and not impacted by those proceedings.
It potentially is limited, and again, I'm not an expert on insolvency, and we have been receiving advice that a lot of what people used to think they could do for asset protection, in reality the court will look through. For example, that you might owe the trust money, or sorry, rather the trust might owe you money. So if you get sued and your creditors go, well, that trust owes you $100,000, they can still probably say, give me the $100,000,
Okay.
etc. Or if you've been financing the trust assets. But as I say, you can't be in a worse of a position by being there, and certainly you probably wouldn't lose your capital growth that you've earned in the trust, because you've probably only contributed just the initial capital maybe to get it there.
Sure.
So yeah, it does stack up. When I talk to clients and your clients about this, I tend to think of that ongoing cost, if we do have risk factors with them,
Yes.
about maybe just being an additional insurance policy. So rather than viewing it as a cost of running a trust, it's $1,200 a year to give you a bit of an insurance policy over your assets.
Yes.
And if you phrase it like that, it does sound maybe a bit more cost effective,
Sure.
but it still is a cash outlay.
Yep.
And that's what we've got to remember.
Okay, so the estate planning and asset protection benefits of trusts, not changed by these proposed revisions to legislation. Tax minimisation, how would that be impacted?
Yeah, well, so fundamentally, trusts, and they're called discretionary trusts,
Yes.
work by having the income of the trust distributed to its beneficiaries every year.
Okay.
And in those trusts, the trustee has discretion about who to distribute that income to within the class of beneficiaries.
Right.
So historically, people might have maybe distributed income to their children,
Yes.
or their parents, or something along those lines. And that's provided maybe some tax benefits in addition to the primary reasons around asset protection and estate planning that they've set the trust up. And the savings in doing that may have helped alleviate some of the cost of running the trust in the first place, and made it a much more palatable option in the short term,
Sure.
especially. So
We're probably talking here around, a commercial asset. It might be $50,000 or $80,000 a year net positive cash flow. There's obviously a lot of money coming in from that property,
Yeah.
surplus cash flow. Distributing that, to other, it might be a child.
an adult child is probably the most common one. Maybe your
Okay.
child just turned 18, went to uni, has no other taxable income.
So you're sort of passing them $30,000.
$30,000, yes.
As a distribution
Yep.
from cash flow from this
Yep.
particular purchase or this trust.
Yep.
And they're not paying tax on that.
They're
So-
generally, or certainly at a much lower rate than maybe you as the adult beneficiary who runs the trust may otherwise have paid.
Sure.
And that's been really common practice for 30 or 40 years,
Yes.
without too many issues. The tax office, we've been expecting an opinion like this to come. They lost a case fairly recently on one part of this. And so we think that probably, as much as anything, prompted them to put this opinion out on paper and say, right, we want to draw a line in the sand now,
Okay.
effectively. It's not going to affect most people who have trust, because most people who have trust probably only distribute to mum and dad and to minor children, so children who are under 18.
Sure.
And there really aren't any major changes in this stuff that will affect those patterns of distribution. What the ATO are really concerned about is people utilising family members on lower tax rates, so adult children or maybe parents, self-employed or self-funded retiree parents,
Sure.
who are on lower tax rates, receiving a distribution on paper, but fundamentally not benefiting from that distribution themselves. So not receiving the cash themselves, and that they fundamentally benefit from. And that's what they don't like. And the rules are around this section 100A, which is what's called a reimbursement agreement. But basically someone gets the distribution, but effectively reimburses it back either to the trust or one of the other people involved in the trust.
Yes.
And that's the ones that we're seeing that they're coming after. All the examples, or almost all the examples they've given in these draft rulings, etc., focus on very high wealth individuals, maybe distributing $180,000 per year to an adult child, because all the others are on the highest marginal tax rate.
Okay.
So that's what they're worried about, but they haven't just made the ruling in respect of that. They've made it basically to any arrangement which provides a tax benefit. Unfortunately,
Right.
yeah.
Okay.
They're not going to like it, unfortunately, going forward.
Right.
Yeah.
So one of the key reasons that we would consider trusts as property investors, and probably not for a $400,000 residential property that might throw off a couple of $1,000s a year in net positive cash flow. The tax savings on that $2,000, if distributed to a child, might only be a few $100s.
Yep.
That might not really, make up for the $1,200 cost to administer. But when we're starting to talk about maybe larger, cash flow distributions, commercial properties, even rooming houses, unit block type assets,
or people who've gone into say 4 or 5 investment properties rather than just the one, and have a good portfolio as well. well.
Absolutely.
Yeah.
And as time goes on, they become more and more positive cash flow, potentially as rents increasing, interest paid down.
Yep.
So this change is fundamentally impacting those tax minimisation strategies from trusts. Estate planning, asset protection, still the same. Some of the benefits around land tax, trusts allow you to isolate properties and to put them under separate entities. Is that been changed at all? Or?
No, that hasn't been changed, and that probably is still one of the key things that we're seeing that might make a trust stack up. It generally depends on multiple properties being purchased. So maybe if someone's just looking to buy one investment property and that's probably going to be their echelon, or even two, they're probably not benefiting. But fundamentally, I think in all jurisdictions, certainly in Tasmania, the rate of land tax you pay will depend on your total land holdings by each registered owner.
Yes.
So in a state, for example, like Queensland, I think the threshold is you don't pay land tax for the first $600,000 of land holdings.
They're changing that, I think.
Sorry?
I think they're changing that.
Are they?
I have to double check.
Whatever the number is,
Yes.
let's say there's a threshold at which point you don't pay land tax, but above that you do then start paying quite a high rate of land tax. Well, maybe you buy the first two properties in your name so that you're under that threshold, whatever it is.
Yes.
Then the third property in a trust, that means that you've got a different land tax holder.
It resets to zero.
Resets to zero.
Yep.
And the cost of that, I think once you start getting above that number, it can be thousands of dollars.
Absolutely.
And then all of a sudden we're in a position where we've got some savings which more than outweigh the cost of running the trust. So if we're looking at someone buying multiple properties in the same state, then those benefits haven't been touched whatsoever. Yep.
Okay, so that's another preserved benefit from trusts.
Yeah.
I think you mentioned the other day when I was having the quick chat with you, grandfathered. Is this going to be grandfathered in retrospectively?
Yeah,
or is this looking forward?
I haven't looked at the ruling. So the draft ruling when it came out said that this will apply potentially back to the last time they provided an opinion piece on this matter, which was July 2014. Wow. So they did say we will look at, or could look at this as far back as 2014. There was a media release on Friday night. They always like to hide them away late on Friday night. One of my partners was at the basketball and reading media releases as he does and happened to find this one. I haven't read it myself yet. I'm not sure if it came from the ATO or from the government, but they have announced that they won't grandfather this rule.
Okay.
On their previous opinion or on historical practices in the past, you should be safe from this matter, and the ruling applies from 1st of July 2022. So historical practices should be okay for the current financial year as well.
Gotcha.
But from that year going onwards, that's when the new rules will apply.
Wonderful. All right, so some big changes underway, a general change in sentiment from the ATO broadly, but then big changes in terms of tax distributions or minimisation strategies around trust structures. Make sure you have a chat to someone who, can obviously walk you through this personally and apply it to your personal circumstances, because it's obviously different for everyone how this might impact. But it might be a pause button on the justification for trust structures more broadly for property investors. It's wonderful to have you on, Scott, and it's been very informative.
No worries.
You've painted a lot of colour and made a conservative, or I guess.
You're allowed to say boring, it's okay.
Nice and colourful. It's good.
No worries.
We might have you back on to talk about the election
in
the next few weeks.
Happy to.
That might be good.
Great.
Thank you very much.
Thanks, Jacob. Cheers.